What's safest right now, Italy or Argentina?
Well, you get paid 40% if you put your money in Argentina, Argentinian local currency bonds. I believe you get paid just over 2% if you lend the Italian government. So I would certainly argue that Argentina is a better bet than Italy at the moment.
Sounds like you're pointing toward an opportunity. However, Brett, we have to highlight a huge amount of risk is involved when you're investing in a country like Argentina.
Absolutely. Very risky country. We've had a new government in Argentina since 2015. They've done some good measures, reduced fuel subsidies, opened up the economy, but they've been a bit slow to reduce the fiscal deficit. The reason we're optimistic is we think they'll get a programme for the International Monetary Fund. They'll do a bit more on reducing how much money they have to borrow, and you have very attractive interest rates now. But clearly, emerging market, clearly it's a risky place.
But surely, though, Brett, I mean, rampant inflation, prices are up 20%, forcing them to increase interest rates to 40%. You've also got weak currency, high US dollar, which makes their debt seem even worse. Really, isn't it worth staying away from countries like Argentina, Turkey even?
Yeah, so Argentina, part of the reason inflation's been high is that they had very subsidised utility rates. The government's got rid of those subsidies. It's caused an inflation problem in the short term. But again, they've had the reaction, hiked interest rates, going to borrow some money from the IMF, and they're going to cut government borrowing. In contrast, we think there are some areas that the sell-off is not opportunity. So Turkey would be a good example where the government remains very reluctant to put up interest rates, and we see continued pressure on Turkish financial assets.
Money leaving emerging markets, where are you seeing this sort of spillover, the contagion effect?
Yeah, I think part of it is because of the issues we've had in Italy. You've seen a period of dollar strength. Normally that's a more challenging period for emerging markets. So I think that's part of the reason that's driven this emerging market sell-off and some of the money that's left. But as you just mentioned, let's look at the oil price. The oil price is important for a lot of emerging countries. That remains high, hitting the highest level for a number of years. Commodity markets more generally are looking good. And actually, we'd take some comfort from the trade deal we seem to have got between the United States and China.
Now, 2017 was a remarkable year, really, for emerging market debt. Is it still a popular asset class going forward into for the rest of 2018, given that rates really are expected to rise in most emerging markets?
Yeah, I think, again, it's a world of contrasts. So if you look at emerging markets, then clearly there's some risks. But, you're getting paid a lot, we would argue, to take those risks in emerging markets.
And how good is return, really, when you consider all the risks involved?
I think, over the longer term, emerging market debt has been one of the better performing asset classes, I think, because it does have this perceived risk involved in it. But, is it riskier to buy Italian bonds at 2.5% yield for the next 10 years or a basket of emerging market bonds that can give you 6 or 7%? Well, we'd argue, perhaps investors have still got a fairly low weighting to emerging market bonds in their portfolio, and that's something they should think about more for the medium, longer term.
But the danger being that while it looks attractive now, I mean, that's a huge difference, the 2.5% versus, in the double figures. But what happens, of course, is when we see inflation and when we see interest rates increase, then it quickly goes the other way and it's not so attractive anymore. Yeah,
I think, on average, emerging market countries are borrowing a lot less than they were 3, 4, 5 years ago. Consumers aren't too stretched in emerging markets. And we would argue that most emerging market currencies are relatively cheap. So, on balance, we're not expecting the sort of issues we saw 4 years ago in emerging markets, particularly given that Chinese growth looks reasonably strong. Commodity markets are, say, in reasonable shape.
So where in the world would you put your money when it comes to emerging market debt? Top 3.
So top 3, we think South Africa is interesting. Obviously, we've seen a change in the president in South Africa, and they're making good progress. And you still paid, pretty high risk premium. India is an area we're constructive on. You've got relatively high interest rates in India. Again, Modi is opening up the economy, and for investors that do have a high level of risk appetite, we would put Argentina there. Clearly big risks around it, but also some potentially quite interesting returns.
South Africa, India, Argentina. Now, Brazil is deemed the safest, though, is it not?
Well, Brazil has certainly made some good progress over the past few years. You have a bit of noise probably around the presidential election we're seeing in the fourth quarter of this year.
And how large has that risk appetite really got to be?
I think our approach for our investors is to run a diversified portfolio. So look at our typical emerging market debt strategy. We're investing in 45 different countries, nothing over 10%. So I think emerging markets, it's about having a diversified approach. Don't put all your eggs in one basket, because as we've seen recently, and as we always see in emerging markets, you can have some quite large risk events at times. So have a really spread portfolio into the asset class.
And would you be investing directly or via something like an ETF?
So we're an emerging debt manager. So our team managed about $18 billion, and we're investing directly into these markets.
Great. And just a quick word on Russia.
Yeah, I think Russia, it's a kind of a tale of two halves.
It's going to be in the spotlight soon, of course.
Yeah, we have the World Cup. I mean, actually, the fiscal framework in Russia is very positive. I think one of the lessons Putin learned in the 90s is that high inflation is bad for any president's popularity, excessive borrowing. So the policy framework we see as constructive in Russia, relatively independent central bank. So it's a macro story we're positive on. Clearly, there are risks around the international environment and further sanctions. But
speaking of those risks, Brett, geopolitical-wise, I mean, where are the issues that disturb you the most when it comes to investing in emerging markets?
Yeah, so I think US-China is kind of on the back burner. NAFTA, upcoming ongoing renegotiations around NAFTA, obviously very important for Mexico. We also have a presidential election in Mexico at the start of July. So Mexico, US, that relationship. We would cite the Middle East, obviously some ongoing tensions in the Middle East, Saudi, Lebanon, they're areas worth focusing on.
And the discussions, the US and China seemingly resolved this trade war scenario. Does that bring comfort? Are you confident we're past that now?
I think, with the US president, things can always pop back up again. So, I think in the short term, there'll probably be a period of calm. Of all the geopolitical risk factors, it's the most important one. China's the second biggest economy in the world. It's the biggest trading partner for the vast majority of emerging markets. So having a stable and growing Chinese economy is really essential. So that's something we're always very focused on.
And taking everything we've said into consideration, Brett, definitely emerging markets over the European markets, the developed markets.
I would say, if we look at commodity markets, they're staying up. Global growth looks in pretty good shape. And you've seen a correction in emerging markets the past 2 months. So, we would argue that's an opportunity to add some emerging market risk.
So none of that personal money of yours is going into the European markets? All your eggs are in the baskets in the emerging markets?
I don't find the Eurozone yields quite so attractive.
OK, very good. And but just speaking about this Iran issue and commodity prices, you're not concerned that that's a positive thing, basically, for your region, that we're going to see these oil prices go up and up? What level could we reach, do you think?
I think it's quite difficult to call the oil price. Obviously, Venezuela's putting pressure on it. And, clearly there are some winners and losers for a higher oil price. But an aggregate for emerging market debt, it's higher oil prices net positive, because the oil exporters, a lot of their government revenue is very dependent upon the oil price. So on aggregate, it's a positive. Clearly, if we were to go up another $20, and that would cause some challenges. But you obviously are starting to see a reasonably big supply response from the United States. And
really, sentiment with the Iran issue, whether it's just sentiment or whether it's real fact, we could easily see those oil prices go over $100 a barrel. It's not out of scope.
Well,
and that becomes then a problem?
Yeah, I think it probably seems unlikely. We are seeing a big supply response from the US oil producers. So we think it's unlikely we get north of $100 a barrel.
Lovely. All right, Brett, thank you very much for giving us your insight.
Great.
Very valuable. Thank you.